Okay, let's move. Now, the salary expenses. So salary expenses, like I told you in our previous slide, this is the gross salary, all right? So create several payroll liabilities, for example, all those liabilities that are included taxes, federal, and also we have the other, for example, pension liabilities as well, all right? So pension going to be included in your salaries, but it will be deducted and retained by the company. Company will invest so that when you retire, company will pay you. All right. So remember, salary expense is always greater than salary pay. Now, unearned revenue. So unearned revenue, also called deferred revenue or revenues collected in advance. Some books also call it advance revenue. So in our book or in our material that we are following, it is unearned revenue. So which means revenue collected in advance, but sale is not happened yet. So what is our expense recognition principle? So you record the sales when actually sales happened. So but the cash is, cash is received in advance. So you record the cash on that day and you create liability, and then you create the sales when sale actually happened. All right. So basically, this results in an obligation to provide goods and service in future. So when you deliver the goods and services, then you record. So let's understand this through an example here. On December 15, Southwest Airline collects $300 for a round trip from Dallas to Los Angeles. So if you pay close attention here, so they collected $300 as a round trip. On December 28, the customer flies to Los Angeles. Dallas to Los, this is the round trip. Round trip means it's a two-way. So it means on 28th of December, the customer already flew into the destination. All right. So which means, and also on 30th of December, it's a closing day. All right. So first of all, when on 15th of December, you received cash. So it's going to be cash increase. That's it. And then did you provide the services? No. So we recorded unearned revenue. It's going to be 300. So on 28th of December, so how much unearned liability? Unearned. So in this case, we have air traffic liability. In airlines, we don't call it unearned revenue, we call it air traffic liability. So if you write it down unearned liability or unearned revenue, it's okay. All right. So how much you have collected? Half of it. It means 150. So 150, you can realize it at sales revenue. All right. And when the customer fly back from Los Angeles to Dallas, fly back to Dallas, then the remaining 150 you are going to record with the same entry, but date is going to be different. Here we go. On 4th of January, customer returned to Dallas. So same entry, but name is date is different. So if you see the unearned revenue liability here, so we created liability increase, right? Now liability is going to decrease. First decrease 28 December and now 4th of January. This is 15. So in that case, we successfully applied the expense and sales recognition principle. Right? So if you understand this, so let's do this illustration together. Here, so we have the company, publishing company that so following transaction for one of its subscriber during 2014. So on October 1st, they sold 1 year subscription, collecting cash 2400 plus sales tax of 9%. So plus means plus. So this is their total sales for 1 year. And on the top of that, 9% tax is going to be collected. So you see, subscription means you pay in advance. Right? Which means you have to, this is the case of unearned revenue. So on 15th of November, remitted sales tax to the state of California. So this 9% you paid to the state, and then on December 31st, you made the necessary adjustment entry at the year end. So remember, the question said 1 year subscription, and how many months? October, November, and December. So it means 3 months from this unearned revenue is earned now. All right. So if you divide it by 12, it's going to be 200 per month. So 3 into is 600. So it means $600 company is eligible to record the revenue in 2014. So let's just talk about the entries here. So first of all, your unearned revenue and 9% of the subscription is received. So cash received 2400 plus 9%. Answer 2616. All right. Unearned revenue or your liability is 2400 and your tax payable is 216. All right. And now you remitted this tax to back to California state. So you paid cash, cash decrease, cash is credit, liability decrease, liability is debit. So it's sales tax payable to cash. So we successfully paid our liability. And now on 31st of December 2014, so among this 1 year revenue, 3 months belongs to 2014. So 600 belongs to 2014. So we recorded as liability decrease debit and sale increase credit. So you see, unearned revenue to revenue. Right? Now, if you understand the concept of unearned revenue, so please choose the correct option here. So when a business receives cash from a customer, before earning the revenue, they credit
unearned revenue.
Well done. Of course, A. So remember, before earning or advanced earning. Look for these kind of stuff and we create liability. So this is liability and it will be shown on balance sheet, not income statement. All right. Well done, guys. Now, current portion of long-term debt. So also called current maturity or current installments. So long-term debts paid in installments. It depends on your terms and conditions. Either you have to pay lump sum amount or either you are retiring the loan with small installments. So you need to look at the structure of the loan. Okay. So if it is that you are paying in installments, then those installments that you are paying will become your current liabilities. And remember, current liability under loan amounts. So guys, you understand? Everyone, Miria, Mirko, Momo, Pavarun, Subhan, you understand? Up till now, what we have
Yes, sir. Yes, sir.
Ken, Venetia, Noon, Priscillo, Tara.
Yes.
Yes, sir.
Good.
Yes, I
Good.
understand.
Okay, good. So company reclassify amount for long term to current, right? Which means portion from the long-term debt is going to be classified as current liability. So up till now, what we have discussed, current liabilities with estimated amount. But now it's time to understand current liabilities with, sorry, up till now what we have discussed, current liabilities with known amounts, and now it's time that we share some light on current liabilities with estimated amount. So there are two types of current liabilities with estimated amount. Number one is warranty payable, and number two is contingent liability. So this is normal business practice that if business is selling the goods, so some goods may be due to some, during transit or something, in the, guys, can you hear me?
Yes.
Okay. So during transit or something, the goods may be damaged. All right. So it is wise for a company to offer warranty services. But how many warranties are going to be claimed by the customer? We don't know. So smart managers, they always plan. Like we talk about in account receivable, the uncollectible. But uncollectible account receivables are over contra asset account, okay, not liability. Otherwise, if they would be liability, they would be definitely here under estimated liabilities. But those are on the asset side, so we don't consider that. So same treatment is here. So there are two ways. Either we make the reserve, all right, or contra account for estimated warranty payable, or we just let it happen. If it happen, we charge it to warranty expenses. That's it. So normally warranty has a period. So the more expensive the good is, more days it's going to be. For a laptop, it is 6 months, 3 months, 1 year. For car, it is 1 year, or mileage, 100,000 mileage or something. For a mobile phone, it's 6 months, 2 months. For house appliances, 1 month, 2 months, right? So this kind of stuff. So company must record warranty expenses in same period that business records the sale. So remember, if sale happened in 2014, all right, and you in November, all right. So remember, if warranty is claimed before December 31st, then it will be recorded in 2014 because sales happen in 2014. So its expenses are going to recorded in 2014. All right. So principle must not be violated.